So we are continuing our conversation about investment vehicle types. And so there's a lot of acronyms in our industry, IRA, TSP, 403B, yada. And it's often kind of confusing sometimes for folks to say, okay, I want to invest, I'm in an area that I can. Where do I start? How do I start? What is the right investment vehicle type for me? And so in part 2, we're going to talk about individual and non-workplace retirement plans. So let's go ahead and investment vehicles. So let's get started. Hey everybody, welcome back. Bill Drexler here. If I haven't met you yet, I'm a certified financial planner. And let's just hop right into it. The first one that we got is a traditional IRA, or individual retirement account arrangement. And in this arrangement, we can set aside funds for the purpose of retirement. And if our income is with IRS guidelines, we can deduct our contributions up to a specific amount. So taxes on the contributions and on the growth will be deferred until they're withdrawn for retirement. And the initial thought was that we'll be in a lower tax bracket in retirement, thus we're saving money and we're being more tax efficient with our investments. However, if the money is taken out before 59.5, the IRS will not only tax it, but they'll also assess a 10% penalty, which can be a costly mistake. The next up is a Roth IRA. And I'm not going to spend a lot of time on the Roth IRA because I did a whole nother video on the Roth IRA because it's that important and it's that powerful. And I will link to it here. All right, to finalize our talk about IRAs, I did want to mention that you need to have earned income to be able to contribute to a Roth IRA or traditional IRA for that matter, per the IRS guidelines, or your spouse needs to have earned income. And the contribution limits, if you're under 50, you can contribute 100% of your income up to $7,000 for 2024. If you're over 50, that's $8,000 because the IRS does provide a catch-up provision in the tax code for that extra $10,000. And there are phase-outs for the deductibility of our contributions in a traditional IRA, and there are phase-outs for our eligibility to even contribute to a Roth IRA, which I discussed in the other Roth IRA video. Next up on the list is a traditional brokerage account, or a TOD, transfer on death account. And these vehicles are investment accounts where an investor can purchase and hold various investments like stocks, bonds, ETFs, mutual funds, index funds, and have them invested for the purposes of whatever they need. This is a fantastic tool if it's not earmarked for retirement. It can be, but there may be other goals, maybe more short-term goals that we want to invest for. Remember, always invest towards the goal, always. These don't have any of that tax treatment that an IRA or a Roth IRA would, or 401k would. But they can be of great use for after you already expended your contributions to an IRA and you've expended your contributions to like a 401k to get the match. And like I mentioned before, they're a fantastic way to invest non-retirement assets, and they can be opened jointly with another person, which an IRA you cannot do. So how does it work? You can open up these accounts at a bank, investment firm, or with a financial advisor in your name, or they could be jointly. And depending on the goals for these monies, remember, always invest towards goal, you can invest it how you see fit. Always talk to a certified financial planner to figure out ways to make that happen. The great thing about these accounts is the funds are liquid from day one. So there's no 10% penalty. You put it in, you can take it out right away. And that's why, investing for something a little more short term, these will work well. You don't have to have earned income to open an account. And you may have also heard that these are called, referred to as general investing accounts, because that is what they essentially are. You can use them however and whenever you want. In addition, there's no contribution limits. You can contribute $1 million if you'd like to. It'd be awfully nice. However, I didn't want to talk about the capital gains in general investing in a TOD or brokerage account. So the way that gains are taxed in these accounts, let's say I purchase ABC stock for $10 and it grows to $15. Well, that $5 of appreciation, if I were to take it out, it would be assessed at a capital gains rate, which can be anywhere from 0 to 15%. Higher income brackets are higher, but that's how that works. And if you're in a lower tax bracket, I think it's the 12% bracket and below, there actually is a 0% capital gains rate. To finalize that conversation on capital gains, I'm going to quickly put up a capital gains tax rate with the corresponding income limits that you would be at, so you can kind of see for yourself what cap gains rate you would be assessed at. All right, finalizing our conversation about investment vehicles is an annuity. So an annuity is a contract between you and an insurance company that will pay out the invested funds in a stream of income over the life of the annuitant. Or you can select the life of you and a co-annuitant. This essentially, it creates a pension fund and it hedges against folks kind of running out of money in retirement. That's really what they are traditionally used for. And there's two stages of an annuity. And the first stage is the accumulation process, where the investor is purchasing accumulation credits. And then finally is the decumulation or distribution phase, where that income stream starts and keeps spitting out money for the investor. And there's two or three types. The first is variable, and variable annuities act very similar to mutual funds. Instead of mutual funds, though, they're called sub-accounts, and they're invested and it can go up and down with the market. And then there's fixed and fixed indexed. And a fixed annuity pays a fixed amount, let's say it's 3% for the life of the contract. And a fixed index annuity follows and mirrors an index like the S&P 500. So a good example is if the S&P returns 10%, then you might have a return of 7%, and the investment company keeps that 3%. There is a surrender period with these contracts. So annuities are generally not very liquid, kind of the opposite of a brokerage account. And a surrender period is a period of time where if you take money out, you will be penalized on that. It can be anywhere from 0 to 10 years is kind of what you see. So you have to be very mindful of that. And they do offer a 10% free out for those, but it's something to be aware of. Pros and cons of an annuity. Pros, it can be a way to help retirees create a stream of income that they can't outlive. They are tax deferred, so that's a fantastic thing. They are tax deferred until you take it out. And then it's taxed on a FIFO basis. The surrender period can eliminate a spendthrift investor's tendency to want to take money out and spend it. So that works. And a fixed index annuities can replace the bond or fixed income portion of portfolios and could potentially have higher returns in those spaces. The cons are they often come with higher fees. Their surrender periods, they add to the liquidity risk that I mentioned. So if you need the money, it's not a suitable vehicle. They were historically sold irresponsibly because you didn't need a designation like the CFP to sell these things. And they also would have high commissions. It's not as bad as it used to be, but they're still kind of high. So just be aware of that. And, if you're a younger investor, there are far more suitable investments for younger folks. That kind of brings us to the end of our talk about investment vehicle types. As I mentioned in the close of the other video, I could go on each single one, every single one of these for an hour or two. I only really touched the surface and kind of presented these are the types out there. Let's now do our due diligence and our own research. If you have questions, just reach out. I'd be glad to answer and elaborate any further. So if you liked this video, subscribe, share it. I would appreciate that. And I'll see you in the next video. And always, always, always be good to yourself and be good to others.